So if you look back at 2025, the global economy was essentially just, well, drowning, right? I mean, you had trade wars, you had these massive West Asian geopolitical
Oh,
conflicts.
absolutely. It was a mess.
Yeah, and the overall growth rate was just sluggish, hovering around, what, 3.4%?
Right, 3.4. And that's with advanced economies basically pulling at the drawbridges.
Exactly. They were slapping massive tariffs on imports, struggling with this really entrenched inflation. But if you looked at India during that exact same window,
It's a totally different picture.
it really is. The economic engine was expanding at a massive 7.6%.
Yeah, which is just incredible given the context.
Right. And somehow defying almost every conventional macroeconomic rule about, high-speed growth, inflation was simultaneously
All
plummeting.
right, which usually doesn't happen.
Exactly. So today we are opening up the Reserve Bank of India's annual report to figure out exactly how they pulled off this macroeconomic magic trick.
It really is a masterclass in navigating crosswinds, honestly.
Yeah.
When you dissect the data, you see this deliberate decoupling of domestic momentum from, well, global stagnation.
Right. It wasn't just a fluke.
Not at all. It wasn't an accident. It was a highly orchestrated alignment of monetary policy, fiscal consolidation, and these really targeted supply-side interventions.
And mapping out that exact orchestration is our mission for this deep dive. If you're listening to this, you are likely preparing for a rigorous assessment and you're staring down, hundreds of pages of tables and charts.
It's very dense central bank terminology.
So much terminology. You don't need a surface level summary here. You need the tactical underlying mechanics. So we are focusing exclusively on an exhaustive exploration of Chapter 1, which is Assessment and Prospects,
Yeah.
and Chapter 2, the Economic Review of the RBI's annual report for the fiscal year 2025-26. The explicit goal here is simple. We are extracting every key term, every crucial statistical shift so thoroughly that you just won't need to read those chapters again.
That's the plan.
We're going to explore the global macro context, the granular breakdown of demand and supply, the new inflation baseline, and all those monetary levers the central bank pulled.
Plus, the definitive projections for 2026-27. The time frame we are analyzing, April 1st, 2025 to March 31st, 2026, it's just particularly crucial.
Why is that specific window so important?
Well, because it represents a structural inflection point. I mean, this wasn't just another year of baseline growth. This was the year India really tested its resilience mechanisms against simultaneous multi-front global shocks.
Wow. Okay, let's unpack this because you really cannot evaluate a country's macroeconomic performance without understanding the geopolitical gravity it was fighting against.
Exactly. You had to look at the global weather.
Right. And the global environment was acting as a massive drag on emerging markets. You mentioned global GDP growth sustained at 3.4% in 2025, which is, a marginal uptick from 3.3% the year prior.
Yeah, but that number, it masks a ton of underlying volatility.
It does, right? I mean, a 3.4% growth rate under those specific conditions seems almost like an anomaly.
It is an anomaly. The report highlights this massive policy uncertainty, primarily driven by, well, high U.S. tariffs aimed at restricting global trade flows.
Right. And rising public debt across advanced economies.
Yeah, and don't forget the severe disruptions in maritime logistics due to the West Asia conflict. Honestly, by all traditional models, global growth should have contracted significantly.
So what kept the global engine sputtering forward instead of just, outright stalling?
The data points to a massive, slightly panicked front-loading of imports, like aggressive supply chain realignment.
Oh, like hoarding.
Exactly like hoarding, anticipating higher tariffs and logistics bottlenecks. Multinational corporations essentially just hoarded inventory. This temporarily inflated global trade volumes.
Wow. And what about the tech side of things?
Oh, massive. We saw a staggering surge in capital expenditure related to artificial intelligence. And concurrently, the China Plus One supply chain realignment forced immense capital into building redundant manufacturing capacity across Southeast Asia and Latin America.
Right. So the sheer volume of capital deployed to build AI data centers globally provided this brute force stimulus to the tech and energy sectors.
Exactly. But, the shadow over all of that is inflation.
Right. Because global inflation cooled down to 4.1% from 5.8% the previous year, which looks like a victory on paper.
It does, but the report explicitly notes that services inflation remained incredibly sticky. And if the examiner wants to test your understanding of the global trajectory, the crucial stat isn't the past year.
Wait, what is it then?
It's the International Monetary Fund's projection. The IMF projects global growth to weaken noticeably to 3.1% in 2026.
3.1%. Wow, that is well below the historical 3.7% average we saw between, what, 2000 and 2019.
Exactly. The 3.1% projection is the realization of that delayed drag. The temporary boosts from inventory hoarding begin to fade, leaving the structural damage of tariffs to finally weigh down aggregate demand.
Okay, so that brings us to the core anomaly of this entire report. While the global fleet of ships is anticipating a severe slowdown facing these tariff anchors, India's ship just accelerated.
Right. Massive internal engine.
Exactly. India remained the fastest growing major economy. It expanded at 7.6% in 2025-26, up from 7.1%. You have to lock that 7.6% figure into your memory for the exam.
Oh, definitely write that down.
But the real question is the mechanism. How do you accelerate your GDP growth by half a percentage point when the global consumers you normally export to are facing a cost of living crisis?
What's fascinating here is that the answer lies in the composition of India's growth relative to other Asian powerhouses. Economies heavily indexed to export-led growth were just battered by U.S. tariffs.
Because their net exports form a massive percentage of their GDP.
Exactly. India's growth, conversely, is deeply insulated by its massive internal market.
So all that panic over the U.S. tariffs in April 2025, the data shows it barely registered.
The impact was highly localized. On a macroeconomic scale, the report notes that net exports exerted a mere 0.1 percentage point drag on India's overall growth.
A 0.1% drag is practically a rounding error.
Right, exactly. When your internal engines are firing at maximum capacity, it barely matters.
Well, let's look under the hood at those internal engines. Because a 7.6% GDP growth rate is just the headline aggregate output. We have to split this into aggregate demand and aggregate supply.
Right. Let's start with demand.
Measured by GDP at constant prices, the growth was sustained by two heavy-hitting pillars: private final consumption expenditure, or PFCE, and gross fixed capital formation, or GFCF.
And the numbers here basically dictate the entire narrative. Private final consumption expenditure grew by 7.7%, and gross fixed capital formation expanded by 7.1%.
Wow, okay, and government final consumption.
That remains steady at 6.6%.
So to put that in perspective for you listening, PFCE at 7.7% means household spending is robust. Like, people are buying things today.
Buying the bread today.
Exactly. Consumption is buying the bread today. But GFCF expanding at 7.1% is the structural game changer. Gross fixed capital formation isn't consumption. It's building a new bakery for tomorrow.
Right. It represents fixed investment, the highways, the heavy machinery, the factory floors.
And what makes that 7.1% GFCF growth sustainable is how it was financed, right?
Yes. The report provides a crucial insight here into the saving investment gap. It notes that the gap narrowed, largely because the household sector acted as this massive net supplier of funds.
Wait, I want to pause here. The household financial savings surplus actually rose to 7.8% of GDP.
It did.
But wait, let's explore the mechanics of that.
Yeah.
Because if private consumption is growing at 7.7%, meaning people are spending heavily, how is their savings surplus also rising to 7.8%?
I know, it sounds contradictory.
Yeah, if you're spending more, you should be saving less.
It appears that way until you factor in income growth and tax rationalization. The denominator, the total disposable income, expanded significantly.
Ah, so the pie got bigger.
Exactly. Wage growth in urban sectors, combined with the rationalization of the GST, effectively increased the absolute capital households retained. Plus, households aggressively locked into higher-yielding financial assets.
Making their savings more efficient at generating returns. Okay, that perfectly sets up the other side of the ledger. We have the demand, we have the capital. What about aggregate supply?
The RBI measures this using gross value added, or GVA, at basic prices. The key exam stat for supply is that real GVA expanded by 7.7%.
Okay, 7.7%. But when you break that down across agriculture, industry, and services, a massive discrepancy emerges. Let's start with agriculture. The sector moderated to a sluggish 2.4% growth. Wait, why the moderation?
That 2.4% moderation was entirely climate-driven. The El Niño weather pattern severely disrupted the southwest monsoon, heavily impacting the Kharif crops.
The crops sown during the monsoon season. I'm going to push back on this, though, because it creates a puzzle. A 2.4% agricultural growth rate usually spells absolute disaster for rural incomes.
Typically, yes.
Right. If the harvest suffers, rural demand collapses. Yet you just noted that steady rural consumption was a key driver of that massive 7.7% private consumption growth. How do those two facts coexist?
That is precisely the kind of analytical connection an examiner will look for. They coexist because agricultural output and rural consumption are no longer perfectly correlated one-to-one.
Okay, how so?
First, while the Kharif crop suffered, favorable Rabi or winter conditions and a late surge in the monsoon pushed reservoir levels to an all-time high.
Right. So the winter crop acted as a buffer.
Yes. And total food grains production hit 348.7 million tons. Make sure to note that stat. But more importantly, rural income has structurally diversified.
Non-farm wages.
Exactly. The government aggressively utilized capital expenditure to build rural infrastructure. Roads, digital connectivity, warehousing. This injected massive non-farm wage income into the rural economy.
That makes perfect sense. Construction buffering the El Nino gap. Now, moving from the fields to the factories, the industrial sector essentially carried the supply side weight, didn't it?
Oh, absolutely. Industry posted an incredibly aggressive growth rate of 9.5%. And within that, manufacturing exploded with an 11.5% expansion.
11.5% manufacturing growth. That is massive.
It is the direct result of targeted fiscal policy translating into physical output. This was engineered by the PLI, or Production Linked Incentive Scheme.
Right, functioning in tandem with the National Manufacturing Mission. For those reviewing the mechanics of the PLI scheme, it's vital to understand why it's so effective. It doesn't just hand out tax breaks for existing factories.
No, it subsidizes incremental sales.
Exactly, from products manufactured domestically. It fundamentally alters the unit economics, making it highly profitable to rapidly scale capacity.
And the report specifically notes this drove massive growth in basic metals, motor vehicles, and transport equipment.
Now, providing the connective tissue between the agricultural buffers and the industrial boom is the services sector, which remained buoyant at 8.7% growth.
Led by trade, hotels, transport, and specifically financial services.
Speaking of technological integration within these sectors, the report highlights a very specific initiative that screams multiple choice question. Bharat Vistar. What exactly is this platform?
So Bharat Vistar, which stands for the Virtually Integrated System to Access Agricultural Resources, is a prime example of digital public infrastructure.
Like an AI tool.
Exactly. It's a multilingual AI-based tool designed to integrate various digital agricultural networks. It processes microclimate data, soil health metrics, and market pricing to provide hyper-localized intelligence to farmers.
So if you see Bharat Vistar on the exam, immediately linked it to AI integration, agricultural productivity, and digital public infrastructure. Okay, now we arrive at the most counterintuitive part of the entire 2025-26 economic review. We have an economy expanding at 7.6%. Demand is roaring at 7.7%. Usually a running engine gets hot. What happened to inflation?
It's the defining paradox of the year. Headline inflation plummeted to an astonishing 2.1%.
2.1%, down from 4.6% the previous year.
Yes, but this is perhaps the single most important technical detail in this deep dive. That 2.1% number is carrying a massive asterisk.
Right. If an examiner wants to trick you, they will target the methodology. What fundamental change did the RBI make to the inflation calculation?
The Statistics Ministry updated the base year for the Consumer Price Index, the CPI, from 2012-100 to a new base year of 2024-100.
Listeners, write this down. Base year changes are classic exam questions. An inflation index is just a basket of goods weighted by household spending. But the India of 2024 spends its money vastly differently than the India of 2012.
The weight rebalancing is drastic. The weight of food and beverages dropped to 36.8% in the new basket.
Down from 45.9% in the old one.
Right. Conversely, fuel and light increased from 6.8% to 10.2%. It captures a more digitized, energy-intensive population.
So looking through the modernized lens of the 2024 basket, what actually drove the number down to 2.1%?
Unprecedented food deflation. Despite the Kharif crop issues, overall supply chain management and the record Rabi harvest resulted in food prices contracting. In October 2025, food recorded a historic 3.7% deflation.
3.7% deflation in food. But if food is 36.8% of the basket and it's experiencing record deflation, why didn't the overall headline inflation drop to zero?
Because of core inflation. And this is where the domestic economy violently collides with global geopolitics.
To visualize this, headline inflation is like the weather outside. It can change rapidly if a storm hits, like food prices dropping.
Right.
But core inflation, which strips out food and fuel, is the climate control inside your house. It takes a lot more to shift it. And right now, what was keeping the thermostat up?
Personal care and effects, specifically precious metals. Gold and silver. Global geopolitical uncertainty pushed safe haven demand for gold through the roof.
Right, billions of dollars chasing a finite supply of gold.
Exactly. And because India imports massive quantities of gold, that global price spike was imported directly into the core inflation metric. So vegetables get cheaper, but gold gets more expensive, keeping core inflation up.
Okay, so with inflation dropping so dramatically to 2.1%, the folks at the Reserve Bank must have been adjusting the dials. Let's look at monetary policy in the control room.
They executed a highly aggressive liquidity injection. The MPC reduced the policy repo rate by a cumulative 100 basis points down to 5.25%.
5.25%. And the cash reserve ratio.
The CRR was also reduced by 100 basis points.
Let's explain that. The repo rate is the interest rate the RBI charges to lend money to commercial banks, like the wholesale price of water.
Good analogy.
And the CRR is the percentage of total deposits banks must keep safely in the RBI's vault water they aren't allowed to lend out. Cutting both means a massive injection of liquidity into the economy.
Deploying the monetary bazooka, essentially.
But why take that risk? Pumping massive liquidity into an economy growing at 7.6% while core inflation is pressured.
Because they were reading the forward-looking indicators, the IMF's 3.1% global growth projection. They needed domestic corporations to keep building infrastructure to offset the inevitable drop in export demand.
Outrunning the global slowdown. And what about the monetary policy stance?
It shifted from neutral to accommodative in April 2025, but reverted back to neutral in June 2025, giving them flexibility.
Now let's shift to government finances. The central government continued its fiscal consolidation. General government dissaving reduced to 4.6% of GDP.
Right. They contained revenue expenditure, day-to-day running costs, and focused entirely on capital expenditure, building infrastructure.
Okay, here's where it gets really interesting. How does all this domestic activity translate to our interactions with the rest of the world, the external sector?
The key exam stat is the current account deficit, or CAD. It was contained at a highly sustainable 1.0% of GDP.
1.0% is incredibly comfortable, but that hides a massive underlying imbalance. India's merchandise trade deficit widened to a staggering US $333.2 billion.
Overwhelmingly driven by the oil import bill. Fast growth equals high demand for Brent crude.
So how does a $333.2 billion deficit mathematically shrink down to a mere 1.0% CAD?
It was offset by a strong surplus in services trade software and business services and steady inward remittances.
The software engineers essentially paying for the crude oil.
Exactly. And international capital flows reflected this stability. India ranks second globally after the U.S. in greenfield FDI announcements.
Greenfield FDI meaning building brand new infrastructure from scratch, not just buying existing assets. Global capital is betting on India.
Which led to net foreign assets of the RBI expanding by 8.2 lakh crore rupees. And the share of gold in NFA increased to 17.2%.
Central banks buying gold too. Now looking at domestic financial markets, bank credit expanded in double digits. But there's an interesting study in the report about how Indians store wealth.
Yes, Barks 2.4.1. It found that bank time deposits and debt mutual funds act as complements rather than substitutes.
Wait, really? Conventional theory says they're substitutes. You pick one or the other.
Right, but investors are using a barbell strategy. Time deposits for guaranteed, immediate liquidity, and debt mutual funds as a speculative play to lock in capital gains from the RBI's rate cuts.
So they serve entirely different risk profiles. Do not call them substitutes on the exam. And what about digital payments?
Massive growth. Retail digital payments grew by 15.1% in value, but an incredible 26.9% in volume.
26.9% volume growth means it's penetrated the microeconomy, buying a cup of tea with digital public infrastructure.
Exactly. The velocity of money is uncapped.
So what does this all mean for the future? We've aced the 2025-26 assessment. What does the RBI predict for the upcoming year, 2026-27?
Real GDP growth for 2026-27 is projected at 6.9%.
6.9%, with risks tilted to the downside, right, due to the prolonged West Asia conflict.
Yes. To insulate against that, the union budget outlined a push in 7 strategic and frontier sectors: electronics, semiconductors, biopharma, rare earths, chemicals, textiles, and capital goods.
I'm repeating those for the listeners. Electronics, semiconductors, biopharma, rare earth, chemicals, textiles, and capital goods. Memorize those. And what are the specific initiatives?
You need to know Biopharma HIT, the India Semiconductor Mission 2.0, and the PM eDrive scheme for electric mobility.
Speaking of PME drive, what about climate and green energy?
ENB exceeded 250 GW in installed renewable energy capacity, and EV sales surpassed 25 lakh units.
Huge milestones. What are the updated nationally determined contributions, the NDCs, for 2031-35?
Two targets to memorize. First, targeting 60% of installed electric capacity from non-fossil sources. Second, reducing the emission intensity of GDP by 47% from 2005 levels.
60% non-fossil capacity and 47% emission intensity reduction. Highly probable exam questions there.
Absolutely.
Well, we have thoroughly mapped the terrain. If you're listening, congratulations on making it through a dense, highly technical deep dive. Let's do a quick rapid-fire summary of the 5 most important stats.
So do.
7.6% growth, 2.1% inflation, 5.25% repo rate, CPI base year updated to 2024 equals 100, and the CAD at 1% of GDP.
Perfect summary.
Yep.
But I want to leave you with one final thought that isn't explicitly laid out in the traditional models.
Oh, what's that?
Look at the digitization. Achieving 26.9% volume growth in retail digital payments, ranking second in global greenfield FDI. As India integrates AI tools like Bharat Vistar, how will this fundamentally shift India from being just the back office of the world to a primary global driver of AI and green tech innovation?
Wow, so moving up the value chain completely.
Right. Is the 6.9% growth projection just the floor for a newly digitized, climate-focused economy?
6.9% is the floor, not the ceiling? That is a provocative thought to mull over. To you, the listener, review your notes, trust your preparation, and step into that exam with absolute confidence. Thank you for joining us on this deep dive.